Well, I'm going to talk about something exciting today, diversification theory. So this is in our part of our lecture series where we understand how we've defined our goals, right? We've looked at the time value of money to define our goals. We understand where we are in the present using accounting and financial ratio theory. And now how do we manage the journey? And the way we manage the journey through the last class is we have to take on risks. And those risks should always result in incremental rewards to the risks that you take on. And if you do that, you should reach the goals that you're making. So only make risks that result in incremental rewards. But how do you manage that risk? And there's one way that we know, a law that always works in finance, and that's through diversification theory. So I was listening to a podcast over the spring break, and it was about Tony Robbins and his investments, because Tony Robbins is a very, very wealthy person. Beyond his book portfolio, he's a wealthy investor. And he had interviewed Ray Dalio, who's also a very famous hedge fund manager. He asked Ray Dalio in his interview, what is the most important law of finance that no one else understands, that if they understood it, they could become wealthy? He said that the value of diversification in portfolio management is the most important thing that you could learn in finance theory beyond time value of money. And why is that? Because returns are linear, but risk is a non-linear function. And so it turns out if you invest in uncorrelated assets or assets that are negatively correlated to each other, assets that behave differently, you actually can minimize your risk while getting the average of all of the returns on your portfolio. So this is one of the few areas in your life where you can make investments and minimize your risk while getting average returns. And so we talked about that in the last class, that there's no free lunch. Normally you have to take on more risk to get more reward. Well, that's only true if you don't diversify your portfolio. If you diversify your portfolio with unrelated assets, so non-correlated or negatively correlated assets, you can actually get the gains and you can also minimize your risk. And so we'll talk through how that works today. But we're going to start off really high level. Let's imagine two people, okay? Person one has a $60,000 a year job. Person two has two jobs. This person each making $30,000 a year. This person works 20 hours at each of those jobs. How much money do they make? They make the same amount of money, right? Okay, now imagine one person, they both lose one job. Who's in a worse situation? Person one, they lose all of their income. Person two loses how much? 30,000, 50%. Let's go one step further. What if we have person three? Person three loses one job. How much do they lose? 20,000. This is a really side version of the power of diversification. As you diversify your assets, which could also be your jobs, you get a benefit that's exponentially declining with how much you diversify away. So as you get the fourth job, you're going to have a smaller benefit than getting that third job, which has a smaller benefit of getting the second job, but you still get a value from diversification up to a certain point. When you get up to like 40, 50 investments, income streams, it really starts to minimize. So in this class, I'm only going to talk about two investment streams or like two asset portfolio, but you get the gist. By diversifying, you have a bigger benefit than not. Lower risk, but you get the same reward. Lower risk, same reward. They lose one job, this person still is okay afterwards. Now what's interesting here is this is counter to what we learn in college. Right? My view is like many of you are going to college to do what? Yeah, a lot of you are trying to get a job, right? One job. And that's a lot of what our education system teaches. It's like get one job, try to get one steady job at one steady career, one steady profession, and work that job your rest of your life. But the statistics show something very different for our generation compared to even my family's generation or my parents' generation, right? Most of us in the Bay Area switch jobs every 2 to 3 years, right? So that's kind of a fallacy that we're growing up through, that we have these set jobs, either through layoffs or through upward mobility. We are incentivized to switch jobs. And so many of us are trained just to focus on one career and narrowly specialize. But what I found through most of my most successful colleagues is they tend to become generalists and tend to have multiple income streams as they move up, because diversification theory proves to us that there's risk with over-specialization. It's not to say it doesn't work out for a lot of people, but for a lot of people it doesn't work out. So my view is college, you're here to learn so you can diversify your income streams and not be reliant on just one job. You should have a job, you should also have an investment portfolio, you should have a side hustle, whatever it is, so that you feel confident in your overall economic substance. So you maximize your reward, minimize your risk. Sound good? Okay, turns out the same thing is true in portfolio management theory. All right, so let's look at three people. We can call them you, we can say Safety Sally, and Risky Jack, okay? They're all lucky, they've all worked hard, they have $1 million to win, all right? They can choose between a 10% return portfolio or a like a S&P 500 kind of investment, market investment, or they can choose between a 4% money market fund. Safety Sally invests everything in her money market fund. At the end of 1 year, what is she going to, if it's 4% on the million, she'll have 1,040,000. Agreed? Okay, we're going to do a 50-50 investment in each. So some basic diversification. Jack is going to invest all his money in a market account. Let's say this is a market crash. What happens to him? And the market crashes 50%. He's going to be left with $500,000. What happens to you if you invest half in the money market fund and half in the investment during a down period? You're going to have $770,000 if there's a 50% decline, because you're still going to get your interest on your $500,000. We can already see here that you don't absorb nearly as much loss as Risky Jack. But there's other benefits to this as well, because you can actually take advantage of the market downturn, which we're going to talk through. Now let's look at the upside. What if you're in a 50% up market portfolio? Safety Sally stays the same, right? Jack has 1.5 million. You're going to wind up with 270,000. You still get to participate meaningfully in the upside. You also get some of your interest revenue. You don't get as much risky as Risky Jack, but you meaningfully outperform Safety Sally, right? And so you get to balance out some of those risks, and then you could re-diversify into your 50-50 portfolio to naturally time the market. All right, so you get to participate meaningfully in the upside and offset the downside just by having a 50-50 diversification. But this isn't where you get the real benefits of diversification. This is just the start. The real benefit is through time value, through investing over long time horizons and rebalancing your portfolio. So you can look at it like this way. Imagine this is the S&P 500, all right? We're gonna have time here and return or price here. Generally, the market will go up and over time, but we're gonna have down and up time horizons. If we are looking at investment theory, what's the investment theory that everyone says? You should buy low and sell. You wanna sell high, right? But how do you do that? How do you know how to buy low and sell high? Can you know how to buy low or sell high? What?
Kind of. Like if you just look at the graph over like the years and see where the pattern is.
Okay, so this is a question in finance theory. There's some people who say information is imperfect and you can time the market. Majority of people disagree with this. And this is evidenced by S&P 500 investment portfolio tends to outperform actively managed portfolios when you review them, which kind of is evidence that actively managed portfolios, they're trying to time the market, that tends to not work. And why is this the case? Well, we have imperfect information. You never know if you're at the top or at the bottom. We can think like, oh, a good example is today. What's happening today? We're in the middle of a war. It's sad, right? We can make a bet on this. We could say, hey, maybe the war is going to get resolved tonight and the market will be up tomorrow. Or maybe the war won't get resolved and the market will be down tomorrow. Maybe it'll escalate. Do we know what's going to happen? No, maybe some people do. Some people have imperfect, that's kind of insider trading. We're not teaching insider trading in this class, right? But we don't know what's going to happen. Also, there's an infinite amount of outcomes that could happen. Anything in between could happen. Or there could be an escalation to an extra wars, or maybe everyone sings Kumbaya and like makes a bunch of money. Who knows, right? Anything could happen. So you could say that you could predict the future. Honestly, you can't, right? There's always black swan events. No one saw the Iranian war coming, or else they would have priced that into the markets. So again, I would also stress, like I always have students in class that there's always one or two of you that are option traders or crypto traders. And I've always had a few good ones who are like, I've made money doing this and I can time the market and I can teach you how to do it. I've done this long enough now where those students come back 3 to 5 years later and then say, Devin, you were right. I couldn't time the market. I lost a bunch of money. I saw them tell me, Devin, if you do this, if you trade these options or you sell these puts, I made $400,000 last year doing this as side income. You got to do it. And they were very public about how well they were doing and buying fancy things, buying country club memberships in Los Altos, that kind of stuff. But then I had those same friends a year or two later call me up crying that they just lost $1 million because they made a bad bet, right? And so if that happens at the highest level of finances, and these are people who are like manly men, they're the guys running marathons and 6-minute miles and making millions of dollars a year, and they can make mistakes like that. What makes you think that you're any different, right? And that's the problem, is there's this ego or hubris where we think we know better than other people. Well, some of the smartest minds in this tend to fail. And so be careful if you think you know better than other people. But how can we take advantage of this then? Because so people are saying buy low, sell high, but you don't know when high happens, you don't know when low happens. So is that useless advice? It's not useless advice. Why? Because you can build a system that actually forces you to buy low and sell high. And that's what a rebalanced portfolio actually does, okay? So if I'm here, market's up. Now my investment portfolio is 60% S&P 500 because it's grown and 40% money market fund. What do I do in a rebalanced portfolio? I have to rebalance it. I sell 10% of my S&P 500, buy the money market fund, and I'm good to go. My money market fund is uncorrelated to a degree. It just moves like this. Now this happens. Suddenly, 60% of my money is money market fund, 40% is S&P 500. What happened? Well, now we just rebalance. Now I get to sell my money market fund when that's high and buy my S&P 500 when it's low. Do you see? So when we have a system, a rebalancing system in place, you actually take advantage of modern finance theory in a way that's actually applicable because the markets go up over time. That's interesting, right? This is actually how you implement the theory buy low, sell high, because you can't do it by predicting the market. Like the market's down today, I could buy it, but then it could go down 10% tomorrow. But if I constantly rebalance my portfolio, then I'm always taking advantage of this. So you need a system, you can't use your emotions. All right? So that's the first way you get the benefits of diversification theory. The second way is called dollar cost averaging. You can actually diversify over time. So something I could do, as almost every student here has asked me, and a lot of professionals too. Devin, I just got $10,000 or $20,000 or $30,000 or $100,000, depending how lucky you are or how unfortunate the circumstances. I got a somewhat amount of money. Should I invest it today? What are my responses to all of you? Well, first, have you paid off your high interest debt? Do you have an emergency fund? Are you taken care of from that perspective? If you say yes to me, then what do I tell you to do? You have two options. You invest a certain percentage of into a portfolio today, but there's a risk that you miss time. What if you buy it today and then the market crashes for the next year? You lost money. So what you could do is diversify your portfolio over time. So if you, instead of buying it every day, maybe I say, hey, if you had $12,000, put $1,000 every month into the market. What would that do? Let's say this is a year. You spend 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here. What you wind up getting is you buy the average of the stock price over the time. So you'll still get the average return of the market by doing that. The only thing when you're doing that is not to delay it too long. If you're going to invest over a 30-year time horizon, you don't want to invest that $1 million or that $10,000, $12,000 over the 30 years. You still want to do it upfront in the time horizon to participate meaningfully in the upside over the long term. How does this work with correlated versus uncorrelated assets? Well, what happens if I'm making this investment and I want to buy General Motors and Ford? If General Motors stock price goes down, what's likely to happen to Ford's stock price? Go down also. Something's impacting General Motors, a car company, public car company in America. It's probably also impacting Ford. What we would say is that these investments are highly correlated. GM, Ford. Now I'm just using these numbers as an example. Remember, correlate tells us how things respond to each other, how multiple assets returns respond to each other. If one goes up, the other goes up, that means it's highly correlated. Perfect correlations mean they respond exactly to each other. Make sense? One goes up 10%, the other goes up 10%. What if you have a zero correlation? What does it mean? There's no relationship to each other that we can find. So what's good for this is your risk-free assets or money market funds are closer to a zero return. We get a zero correlation. So that's a natural asset that's easy to buy that has no correlation. What about negative? Negative mean they act opposite to each other. So a negative would be something like this. Does the exact opposite relationship. What would be an example of a negative correlated asset? You can imagine we could have something like, if you have green power, like solar, potentially a negatively correlated asset to that might be coal. Maybe not, because they're both power plants, but you can imagine solar. If solar does well, coal power plants might struggle. If coal power plants do well, solar might struggle. Any laws impacting one will impact the other. What you're going to find is you only get diversification benefit from assets or investments that are negatively or uncorrelated, not perfectly correlated. They have to behave differently under different circumstances. Similar to what we talked about here, right? As only way to get rebalancing benefits through our portfolio management is what? We have to be able to rebalance the portfolio. They have to respond differently to different market conditions. So if I have them respond the same to the same market conditions, then I'm screwed, right? I can't rebalance my portfolio because they're both up or down at the same time. So this is what Tony Robbins was talking about when he talked to Ray Dalio, right? The challenge is, how do you find uncorrelated assets? And so one of the tricks that they used to do is the S&P 500 index funds. I can buy a set of 500 stocks in an index fund, and those should naturally have different varying degrees of correlation. Now here's the problem. When everyone starts buying the S&P 500, all of them start becoming correlated to each other. If you buy Google right now, it increases the value of the S&P 500, which increases everything in the S&P 500. So the correlation increases over time. So it's a constant game. This is where portfolio managers get really sophisticated. If you're a good portfolio manager, you're always looking for an investment that has no correlation or negative correlation. In a perfect world, if you were to have a S&P 500 investment and a negative correlation to it, you could effectively negate the majority of your risk. If you had 20% risk in your portfolio and you had a negative correlated asset related to it, it might get you down to 2.5% risk. So you could get all the return with no other risk. But how do you find that? How do you find those perfectly negative correlated? You really can't. It's really challenging. There's active portfolio managers looking for those assets all the time. You can't find it unless you're actively looking, and then once you find it, people buy it, and then it starts to be correlated to the portfolios that they're investing in. Okay, so what can you do? Well, you can own an uncorrelated asset, which goes back to your money market funds. And so I'm going to tell a story of a friend who I know, sad situation, his grandpa passed away, left him $1 million. So sad situation, but he was fortunate to get $1 million. He also works at Google. He's married to a wife who works at Google, and they've saved up about $1.5 million, all in retirement accounts. They put all of their $1 million down on a townhome. Then they had a surprise. The HOA in the house that they bought had a special assessment, charged him $50,000. Huge random bill. And he only had $30,000 in his emergency fund. And he called me up and he said, Devin, I don't know what's wrong, but like now I have to sell, the market's down. I have to sell my investments. I'm going to lose a bunch of money. You're a finance teacher. Well, like, what did I do wrong? And this guy's a CPA. This guy's an expert. He's like, what did I do wrong? I said, your emergency fund's not your problem. The problem is you're invested in highly correlated assets. You don't have an undiversified portfolio. If he had a degree of funds in his money market fund, it wouldn't be an issue. That would have still gotten gains. And he would have been able to pay for that HOA fees, those HOA fees out of that surprise bill, out of his gains. But he owns real estate and S&P 500, which are highly correlated to each other. So if you have diversified assets that are correlated to each other, they're not really diversified. They have to be uncorrelated to each other or negatively correlated. Does that make sense? You following along? Okay, cool. We'll do examples later, but there's mathematical ways to prove that diversification is only benefits if you have uncorrelated assets. So your returns are always going to be linear or related to each other. So your portfolio returns are always the weighted average of all of the underlying assets returns. Another way to say this, if I own 50% of a company, that gives me a 10% return, and 50% of a company that gives me an 8% return, what's the return of my portfolio for that company? 50% is 10%, 50% is 8%. What's the return of my portfolio? 9%, right? You just take the weighted average. 10% and 8%, the weighted average is 9%. It's 50-50. Now, the risk though, if you're perfectly correlated, let's say the risk was 20%. If it's perfectly correlated, you take the weighted average of the risks. If it's unperfectly correlated, you actually offset that from the weighted average of the standard deviation or the risks multiplied by your correlation coefficient. So as you become more negative, you actually offset your risk. And we'll do examples in your workbook, but I just want you to understand that you have an exponentially declining impact based on how uncorrelated your assets are. So you got to continue to rebalance your portfolio. When one stock is up, if the other stock is down, you can buy the down stock when it's low, keep the up stock when it's high, and can sell some of the up stock when it's high, and continue to balance this, and you'll actually minimize your risk while maximizing your reward. That's cool, right? Okay, so we'll do that in your workbook on Thursday. We'll practice that heavily on Thursday for some examples, but all that is essentially using this equation to determine what your level of risk is. Any questions so far on diversification theory? Okay, now how does this go into portfolio management theory? First off, we're no longer going to just be talking about assets. We're talking about portfolios. When I say portfolio, I'm saying a combination of investments or a combination of assets that have a combined specific risk return. All right? We can lay out all of those investments we can have our return here and our risk here. What happens if we look at all types of portfolios? What you're going to find is something kind of crazy. Because there's hundreds of thousands of portfolios. What you get is kind of a C-shaped curve. This C-shaped curve is called the efficient frontier. And if you think about it, it makes sense. The lower the risk, the lower the return. As your risk increases, we see some portfolios that have done exceedingly well, and some portfolios that do exceedingly poorly. It makes sense. As risk increases, okay. So how do you know what a good investment is when you're looking at these bets for your company, if you are going to manage someone's portfolio and you need to make a recommendation, how would you advise them based on this? Now you can look at all these portfolios, what would you advise? What are the best portfolios? Where would they be in this? On the top of the efficient frontier. Those are your best portfolios, right? They're the ones that have the highest return. But we also noticed something very interesting. There's a point where your return starts to level off while your risk increases. Yeah, we have some portfolios that have very, very high returns with very high risk, but it's not increasing at the same unit of return as the same unit of risks. It's starting to level off. And this makes sense intuitively. If I was to ask any of you today, if I was to say, I'm going to give you $1 million, You can keep half of any of the money you make, but you have to make it today. What would you guys go do?
Like an options, like something that's really quick, it'll pay off quickly.
Okay, if you can't trade options, what's something else you would do? I'm surprised no one's saying it.
Crypto.
Well, you only have a day. Okay, if you're asking me, I'd take it at a blackjack table, right? Like, let's go gamble and hope I make you some money because you didn't list any consequence if I lose the money. You only said consequence if I gain the money. I got to keep half of it. But what's your best outcome? If I put everything on black, what do I get? It's about it's a little less than a 50% chance that I get double the money and a little more than 50% chance that I lose it, right? And that's kind of where your risk reward caps off. That's kind of your best bet in gambling and also investments. You're not going to get a better bet where 50% chance that you lose all your money, 50% chance that you gain it. That's a really high risk, really high reward, right? So it makes sense. That's where it levels off. Everything after that, we start getting to kind of craziness, right? Like you can increasingly take risk to the point where you like playing the lottery. You have 1 in 1 billion chance or whatever it is that you can win really. The risk is extremely high, but the reward is likely low. Reward is not going to happen. Your risk is like 1,000,000%, right? Does it make sense? So this graph makes intrinsic sense. Now, if you're recommending to make an investment to somebody based on this graph, what would you recommend to them? This starts to be really high risk over here, and the reward starts leveling off. Well, your reward goes up pretty fast on the left, right? Our reward's moving up exceedingly fast. So it turns out that on this side, we get the most reward for incremental unit of risk taken. And so we've developed the ratio called the Sharpe Ratio that decides what is the highest amount of reward for incremental risk taken. And so that's your return of your portfolio minus your risk-free rate over your units of risk. So you're just saying, it sounds complex, but again, I'm not trying to scare you with the math. Just for every unit of incremental return, what's your unit of risk? You're looking at all these portfolios and you're trying to find the maximum portfolio. It just so happens that portfolio is if you take your risk-free rate of return and you map out a line, it turns out those are called the tangent portfolios. It's the portfolio that maximizes your return for level of risk. This line is called the capital market line, CML. This is called a tangent portfolio. And it's just a portfolio that optimizes your Sharpe ratio, which is the maximum portfolio that gives you the maximum return for level of risk. Remember, each of these portfolios are comprised of diversified asset classes. And it turns out generally those tangent portfolios have uncorrelated or negatively correlated asset classes within their portfolio that are consistently rebalanced. And so if I ask you to figure out Sharpe ratio, you just have to do this. If I give you a graph and say, which is your best investment for unit of risk, you choose your tangent line. Now, here's a question that'll trick people up. Is this the portfolio that maximizes your return? No. There's a bunch of other portfolios that maximize your return. They're just at exceedingly higher levels of risk. And if I was to advise a client, why would I tell them to take extra risk for potentially less return for each level of unit of risk that we've taken on? And that goes back to the last law we talked about, right? Is only take on risks if you have a reward that is incremental to the risk that you're taking on. It invalidates that law. So good examples like Tesla. Tesla could have huge returns if they figure out robotics, but they could also have huge losses. So maybe they'll have higher returns, but the volatility and the risk isn't worth it. Okay, only other things we want to talk about here is just remember risk. We have idiosyncratic risk or unsystematic risk and systematic risk. And just remember, diversification is only going to take away diversifiable risk. So that unsystematic risk. So we have risk like if one CEO causes a problem or goes to jail. In GM, if you bought Ford, well, hey, Ford didn't cause the problem, so you at least diversified away. So there's certain risks that you can diversify away from. There's certain risks that you can't, like war, interest rates, global interest rates. Those are undiversifiable risks. They're still present in the system, and you should get a return based on that. And for this class, we're saying money market funds, but in reality, that's a little more complex than that. Okay, any questions on diversification and portfolio management theory? And I think we all understand this intrinsically, but we're not trained for it in college as well as we should be, in my view. But we try to do it with general education. Who's more likely to be successful in the long term in their career? An engineer who learns how to Python and different language encoding, or an engineer who learns Python and gets very good at public speaking? Probably the one who also gets good at public speaking. In my profession, the managers, the leaders, the ones who are more successful are the ones who are really good at interviewing and public speaking. If you are really good at audio-visual stuff and you take videos and photography and you get good at also Photoshop, or you become really good at sales, who's probably going to be more successful? The person who has a more diversified skill set, the person who's able to do more things. The generalist, you want to be a master of certain domains, but also have diversified skill sets that are not correlated to each other as much, right? So same in your career, same in your relationships. Is it better if I have a friend who's an accountant, someone who's in finance, someone who's in marketing, someone who's in health, someone who's spiritual? Who's going to round me out better? If you have diversified advice from unrelated sources that are expert in their own domains. Same in your career. Who's going to be better, the accountant who stays in the same role the whole time, the marketing person who only works at one company, or the one who gets exposed to a lot? That's why people in consulting tend to do really well. They get exposed to a lot of different projects, right? So these theories, these laws, don't just matter in your finances. They hold true in all domains of your life. But we're learning them for finance, and that's what we're going to cover in the workbooks. I hope you take it seriously. This is really valuable. If you're stuck around the same old people, giving the same old advice on the same social media channels, whatever you're doing that's reinforcing your beliefs, I would challenge you to diversify your views, diversify your portfolios, because you'll get the average of the returns, but you'll exponentially decline the risk that you'll make a bad decision.